In this video, let us discuss capital receipts. These receipts are two-way transition. That means once the money is given, it will come back in the form of income or any asset created out of the disbursed money. Capital receipts are further divided into debt capital receipts or non-debt capital receipts. Debt capital receipts. Loans received by the government is debt capital receipts. That includes borrowings. Borrowings are money that is taken out of consolidated fund of India and repayable out of it. There are two types of borrowings, internal borrowings and external borrowings. Internal borrowings. Money borrowed within the country from various sources and instruments is called internal borrowings. It is further divided into market loans. Market loans are borrowed by Government of India by using government securities. Here government securities is issued to borrow money from the public. Treasury bills issued to RBI and banks. Treasury bills, that is T-bill, is issued by government to RBI and banks and not to public. It is short term in nature. It is no interest bills. That means no interest need to be paid. It is issued at a discount rate of the original price. If the original price is 1000 rupees, it is issued lower than the 1000 rupees and it can be redeemed to full amount on redemption at a maturity date. T-bills maturity differs like 14 days, 182 days and 364 days. Other internal debt. Debt raised to meet budget needs apart from the previous two methods is called internal debt. Funded securities. Short-term T-bills are converted into long-term market loans to defer the payment or funded securities. Other special securities issued to RBI. Bonds issued by the government to raise funds which is outside of its annual borrowing programs such as oil bonds, fertilizer bonds were classified as special securities. Cash management bills. Cash management bills are short-term debt instruments issued to meet the temporary cash flow of Government of India. The cash management bill have less than 91 days maturity. These are issued at discount price like treasury bills. Ways and means advance. These are temporary loans given by RBI to government. This loans is restricted up to a maximum of 3 months. Market stabilization scheme. It is both physical and monetary instrument. In this, physical instrument is issued by government and monetary instrument is issued by RBI. This instrument is issued to control excess liquidity due to foreign exchange flow which leads to inflation. To control the inflation, government issued securities through RBI to control inflation and reduce the excess money supply. Special floating and other loans. Special loan schemes are issued to raise money by launching new scheme to raise money and interest. Compensation bonds. Compensation bonds are issued by Government of India to affected person by its policy decision. For example, government abolished Zamindari system and to compensate their loss, the government issues bonds. Non-negotiable, non-interest bearing securities issued to international financial institution. These securities are issued to international financial institution like World Bank, Asian Development Bank, etc. External borrowings. Money borrowed from outside the country as loans and instruments is called external borrowings. They are classified as multiple and bilateral loans. Multilateral loans. These are loans received from multilateral agency like World Bank, International Monetary Fund, etc. Bilateral loans. These are loans received from foreign governments directly. Other liabilities. Liability here means the responsibility to pay money back. They are money deposited in custody of Government of India for public. This money is kept in public accounts of India and paid whenever claimed. They are small savings schemes, provident funds, reserve funds and other funds. Small savings scheme. It includes all small saving prior to the creation of National Saving Scheme Fund. Provident fund. It includes general public provident funds and state provident funds prior to creation of National Savings Scheme. Other accounts. Deposits of non-government provident funds to securities issued to nationalized banks, oil companies, etc. Reserve funds of the railway, posts and telegraph. These funds are created by railway department to meet fluctuation in revenue by using as a buffer stock. Non-debt capital receipts. Amount received by government from disposal of its asset except public sector assets which will be credited to the National Investment Fund, and recovery of loans to given to other. They are listed below. Recovery of loans and advances, disinvestment of government shares other than public sector unit. This disinvestment is credited to public account under National Investment Fund. Thank you for watching this video.